Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us discuss now one question of admission of partner where new partner has brought amount of goodwill in cash and goodwill amount is retained in business. How to give treatment to such adjustment of goodwill, that will be understanding in this question. Let us read question. The balance sheet of Shekhar and Sridhar as on 31st March 2012 is set out below. They share profits and losses in the ratio of 3:2, that is 3/5 and 2/5. This is called as old ratio. Ratio between old partners. Balance sheet of existing firm. Asset side we have building, furniture, stock, debtors, cash balance. We have profit and loss account. This is loss as it is there on asset side. This will be divided among old partners in the ratio of 3:2. It will be divided as 12,000 Shekhar and 8,000 Sridhar. That is in the ratio of 3:2. They agreed to admit Murlidhar as partner. So Murlidhar is a new partner. As partner into firm on following terms. He should bring 24,000 as capital. So new partner brings capital. Cash comes in. Cash account will be debited. And Murlidhar capital account will be credited. And rupees 18,000 as goodwill, which is to be retained in business. That means new partner brings amount of goodwill in cash. Amount is distributed among old partners in sacrifice ratio, but they don't withdraw that cash from business. It becomes part of their capital. He will be entitled to 1/4 share in future profits of the firm. This is the profit share of new partner in future firm. 50% of general reserve is to be remaining as reserve for doubtful debts. Here we have general reserve 48,000. Of this 50% will become RDD. That is 24,000. Balance 50%, 24,000 will be distributed among old partners Shekhar and Sridhar in the ratio of 3:2. Furniture is to be depreciated by 5%. Furniture is 20,000. Depreciation 5% means it will be reduced by 1,000 on asset side. We'll have second effect, profit and loss adjustment account debit. Stock is to be revalued at 30,000. Stock given 24,000, new value 30,000. So it has increased by 6,000. It will have second effect, revaluation account credit or profit and loss adjustment account credit. Creditors of 2,000 not likely to be claimed, means it is a discount received from creditors. Creditors will be reduced by 2,000. Second effect will be profit and loss adjustment account credit. Hence should be a written off, that is cancelled. Rent of rupees 1,000 due but not received and it has not been recorded in the books. It's not received means it's outstanding income receivable. It will have one effect on asset side. Second effect, profit and loss adjustment account credit. Prepare revaluation account, partners capital account, and balance sheet of new firm. Let us open necessary accounts. Let us do working note for goodwill. Rupees 18,000 is brought by Murlidhar as goodwill, which is to be retained in business. Treatment of goodwill. Goodwill brought by new partner and old partner retained it. For goodwill received in cash from Murlidhar, our entry is cash account debit to goodwill account. 18,000 being goodwill received in cash from Murlidhar. For amount of goodwill distributed between old partners. For goodwill distributed between old partners in sacrifice ratio. Here new partner is admitted for 1/4 share as it is given in the question. New firm separate profit sharing ratio is not given. So whatever is the old ratio of the old partner, same will become sacrifice ratio. We are not required to calculate it by preparing separate working note. If they are not given new profit sharing ratio separately in question, we can understand that whatever is the old ratio, same will be sacrifice ratio. Therefore, old ratio is sacrifice ratio. So in that ratio, we have distributed goodwill between old partners. Goodwill account debit 18,000. To Shekhar's capital account 10,800. To Sridhar's capital account 7,200. Being goodwill distributed in sacrifice ratio 3:2. Let us go through the balance sheet. On liability side, we have capital account of Shekhar, Sridhar. These will be transferred to their respective capital accounts. On credit side, by balance brought down, Shekhar 80,000, Sridhar 60,000. Then we have general reserve 48,000. Of this, 50% is to become RDD. Balance 50% will be transferred to the credit of old partners capital account in profit sharing ratio 3:2. Partners capital account credit by general reserve, Shekhar 14,400, Sridhar 9,600. On balance sheet asset side, we'll have debtors less RDD out of general reserve 24,000. This effect will not have on revaluation account. Half general reserve distributed among old partners in profit sharing ratio, half is transferred here as RDD. Alternatively, same amount of RDD can be shown here on liability side, but correct disclosure will be debtors less RDD. Creditors 32,000. There is adjustment on creditors. Creditors will be recorded on liability side. Balance sheet liability side, creditors 32,000. Asset side we have building. There is no adjustment on building. 40,000 will be directly recorded in new balance sheet outer column. New balance sheet asset side building 40,000. Furniture 20,000. There is adjustment on furniture, so it is recorded in inner column. Stock 24,000. There is adjustment on stock. Stock is recorded in inner column. Debtors, there is adjustment relating to RDD created out of general reserve. Debtors are 80,000. Debtors 80,000 less RDD 24,000. So net debtors are now 56,000. Cash 36,000. There will be increase in cash due to capital and goodwill brought by new partner. So we are leaving space to record that. Alternatively, we can do calculation here in bracket, and final balance of cash we can record in outer column. Profit and loss account, it's a loss 20,000 distributed between old partners in profit sharing ratio 3:2. Partners capital account debit to profit and loss account. Shekhar 12,000, Sridhar 8,000. Let us go for adjustments. They agree to admit Murlidhar as partner into firm on following terms. He should bring 24,000 as capital. Entry will be cash account debit as cash comes in. Cash account debit to Murlidhar's capital account because it is a capital of Murlidhar. Credit the giver. Capital will be credited. Partner's capital account Murlidhar column by cash 24,000. Balance sheet asset side cash 36,000. It will go up due to capital of Murlidhar 24,000. So it will become now 60,000. Alternatively, we can open cash account where this amount will be debited. Rupees 18,000 as goodwill. We have done working note for goodwill brought in cash. Entries cash account debit to goodwill account. So cash will go up by 18,000. 60,000 plus 18,000. Now total cash closing balance is 78,000. Goodwill account is credited over here. Same goodwill account is debited for 18,000, so it gets closed. If we open an account, we can see that goodwill account gets closed. It will be first credited as by cash 18,000, then it will be debited to Shekhar to Sridhar. So now we can make posting in old partners capital account, credit side. Partners capital account credit, Shekhar and Sridhar column by goodwill 10,800, 7,200. This is goodwill distributed among old partners and retained in business. After completing adjustment of goodwill, let us move further. Second adjustment says 50% of general reserve is to remain reserved for doubtful debts. Out of total 48,000 general reserve, 50% we have created as RDD and deducted from debtors. Balance 50%, that is 24,000, we have credited to partners capital account on credit side, that is old partners. Furniture is to be depreciated by 5%. Furniture here is 20,000. 5% will be 1,000. So that depreciation 1,000 will be debited to profit and loss adjustment account or revaluation account. Revaluation account debit to furniture 1,000. New balance sheet asset side furniture 20,000 less depreciation 5% 1,000. Net it will be now 19,000. Stock to be revalued at 30,000. Stock here it is 24,000. That means it is gone up by 6,000. It will be recorded to the credit of profit and loss adjustment account or revaluation account. Revaluation account credit by stock 6,000. This will have second effect in balance sheet. Stock here we have 24,000. Add increase in amount of stock 6,000. So it will be 30,000. Creditors of 2,000 are not likely to claim, hence should be written off. This is discount received on creditors. We'll have to deduct 2,000 from creditors. Second effect, profit and loss adjustment account credit or revaluation account credit, as there is decrease in liability. Discount from creditors is recorded to the credit of revaluation account 2,000. Balance sheet liability, creditors 32,000 less return of 2,000, outer column 30,000. Rent of rupees 1,000 due but not received. So receivable, not recorded in books. We'll have one effect, asset. Second effect, revaluation account credit. Revaluation account credit by rent receivable 1,000. Balance sheet asset side, rent receivable 1,000. With this we have completed all adjustments. Let us close revaluation account to find profit or loss. Revaluation account debit to profit, Shekhar's capital 4,800, Sridhar's capital 3,200, that is divided in the ratio of 3:2. Revaluation profit should be divided only among old partners. Partners capital account credit. By revaluation account, profit transferred 4,800, 3,200. Now we can close partners capital account and balances will be transferred to liability side of new balance sheet. We have closed partners capital account. Shekhar 98,000, Sridhar 72,000, Murlidhar 24,000. These amounts will be transferred to liability side of balance sheet. We have transferred all partners capital on liability side. Shekhar 98,000, Sridhar 72,000, Murlidhar 24,000. We have closed new balance sheet. Asset side total is 2,24,000, which is equal to liability side total 2,24,000. That means new balance sheet is tally. In this question, we learn how to give effect to item of general reserve when it is required that part of the general reserve is to be converted into RDD and balance general reserve to be distributed among all partners in old ratio. Thanks for watching this video. Stay tuned with Ekeeda and subscribe to our channel Ekeeda. Thank you.